All right, welcome to today's talk. We're talking about money and what you need to know to have more of it.
Investment applications from Hong Kongers.
Why are investors so
Say
bullish?
I have, $200,000 to invest.
Let me ask you this: are we in trouble here or not?
I don't think so. I think in order to get
$10,000, I have
Investment
$100,000,
institutes
I have $1 million. What should I do?
May well lengthen the period of weak economic performance.
Investor and star of Shark Tank is back on Kiko to give us his outlook on the economy.
Live from Beverly Hills is the
It was the worst day on Wall Street.
Investment institutes.
Investors could be worried about here, but it's
knowledge.
15 foolish investing mistakes new investors make. The only constant in life is change. The same can be said for the stock market. Stocks go up, they come down. People find themselves on the top of the world overnight. People cry when it doesn't last. An investor's ability to capitalize on that change determines investment success or failure. And no, it's not as easy as buy low, sell high. If only it were. When the market is going up, many new investors jump in. In fact, a Charles Schwab Investor Survey found that around 15% of current US stock market investors began investing in 2020. All that new blood is great for the market. Welcome. But mistakes get made. It happens to all new investors and veteran ones too. They just don't know what they don't know and have just yet to find out. We all have to start somewhere, and with analysts calling for runaway inflation, not investing is not the answer. But no one has to lose their shirt. We've gathered 15 of the most common investing mistakes new investors make, but you don't have to. Mistake number 1. Positive they'll outwit the experts. All of the seasoned investors are wrong, but the new investor is right. Not likely. Now, this isn't unheard of. In 2011, Netflix split its DVD and streaming services, which meant people now had to pay more if they wanted both. They lost nearly 1 million subscribers, and their stock tanked 27% in after-hours trading. Seasoned investors and analysts alike believed that the lost membership meant Netflix made a big mistake. But despite the supposed faux pas, subscriber numbers and revenues increased by the end of the year. Those who bought it when everyone else was selling would now have roughly 15x their original investment. The takeaway here: it can happen, but it's more likely that investors are suffering from the Dunning-Kruger effect. This scientific principle basically says that the less people know about a topic they're learning, the more confident they are that they've already figured it out. Mistake number 2, too much turnover. Only experienced day traders make money buying and selling within short time frames, also called portfolio turnover. A few good trades can make this seem like a good strategy, but this is akin to winning a few hands of blackjack, then going all in. All that positive reinforcement leads many investors to move significant money into a fund they've pegged as a winner, only to see all their recent earnings disappear. On top of that, taxes and fees the investor might not account for at the moment can really add up. But don't take our word for it. According to NASDAQ, and they should know, investors who have high turnover earn on average 15% less each year than those with low turnover. Mistake number 3. They think they have all the time in the world. The average stock market return per year is around 9% per year. So every 7 years, the original investment plus any returns doubles roughly. Now, what does that mean in real money? Let's imagine an investor started investing $100 per month at the beginning of 1970, which is probably before most new investors were born. If we adjust for inflation from then to now, that's about $660 a month in today's money. Over 50 years, this investor invested $48,000. If they're earning 10% per year on average, they now have about $300,000. Again, we're adjusting for inflation here, so this investor did sextuple their money. Now, what happens if that same investor waited until 2010 to start investing and planned to retire in 2020? Lucky them. They would invest $12,000 and maybe double their money to $24,000 if that average held for that 10 years. So the difference between giving the money 50 years to grow and giving it 10 years is significant. Growth compounds over time. When returns compound, their original investment is making them money. But now, the money they made in the stock market is also making money on its own. Then the money that the money makes starts to make more money, and so on. That's the power of compound returns. So if the investor waits until age 30, 40, 50 to start investing, they have less time to let compound returns do their work. But this leads us to our next mistake. Mistake number 4, assuming the market will always rise. You'll hear stats like the average stock market return is 10% per year. But many people forget this is an average. The stock market doesn't go up in a straight line. It goes up and down. But historically, it's always been on an upward trajectory over time. The same cannot be said for any individual stock, but when looking at the whole stock market, this is true. In 2007, during the housing crisis, the Dow went down from a high of 14,000 to 8,000 by January 2009. That represents a lot of shirts lost. But in July 2021, the Dow is hovering around 35,000. On average, that's 10% yearly growth. But those who sold between 2007 and 2009 are kicking themselves right now, which takes us to the next horrifying newbie mistake. Mistake number 5, following the masses. New investors will hear a lot of doom and gloom when the stock market is tanking as it did during the housing crisis. It's scary. And those fears are matched by their declining portfolio. But as Warren Buffett would tell you, this is usually the time to buy more of the companies you expect to weather the storm, not sell. This is what seasoned investors are talking about when they say buy low, sell high. Of course, the issue is that you don't always know when the market has bottomed out. So don't pay too much attention to trying to time the market. If you don't need access to those funds in the next 10 years, you're more likely to come out ahead regardless of when you buy during these downturns. Mistake number 6, spending too much time speculating. Should we buy the stock or not? Is it going to go down further? Can it be caught on the upswing to make instant bank? Spending too much time deciding whether or not to purchase or sell a stock can backfire. New investors often miss opportunities this way. They're afraid to pull the trigger, and so they miss their chance. But this can go in the other direction as well. Mistake number 7, FOMO buying decisions. New investors might also let their fear of missing out drive their investment decisions. People who buy out of fear most often miss the red flags or fail to do their research. They get caught up in the moment and often abandon their investment strategy. FOMO can be particularly intense if someone else is telling the new investor to buy. This could be a friend, relative, mentor, or investment guru. New investors should know investment opportunities come and go, but they come and go constantly. So missing one big opportunity is not the end of the world. Instead, new investors will do better if they have a no regrets policy when investing. That's not to say that losing money, even on paper, doesn't hurt, but getting overwhelmed with regret will just hold a new investor back from reaching their true potential. Mistake number 8, thinking they'll beat the market. This one is the equivalent of someone believing they can beat a chess grandmaster if they just picked the game up last weekend. New investors need to understand that they are competing against seasoned investors when they invest in the stock market. This isn't to say that it won't happen like the recent Robinhood GameStop fiasco, where new investors sent GameStop prices soaring from $35 a share to $347 after collectively following a hot tip on Reddit. But the chances of new investors being on the receiving end of this kind of freak event are even less than becoming internet famous. Why? Because as soon as those new investors start cashing out, that house of cards falls, and someone has to be left holding the bag. Mistake number 9, not understanding the investment. Warren Buffett cautions investors not to invest in companies if they don't understand their business models. Ideally, all new investors should learn how to understand SEC filings. These filings are publicly available online and demonstrate the financial health of a company as well as its overall strategy. But honestly, some companies are shams and may even be scams. They get investors excited with big promises, but have no real way to make money other than generating capital by enticing eager, naive investors to drive their stock price up. If an investor doesn't understand how the company makes money, then they should steer clear. We saw a lot of investing in companies with no revenue generation models in the late 90s during the tech bubble, which didn't end well. But we've also seen more recent examples, like Luckin Coffee in December 2020. This company billed itself as the Starbucks of China and was once valued at $12 million. With an alleged network of fake employees and customers, they fooled investors and were subsequently removed from the New York Stock Exchange. Mistake number 10, they like a product. Investors who invest because they like a brand aren't buying for the right reasons. The goal of investing is to make money, not shower Apple or Adidas with affection. We all want to feel more connected to the brands we love, but investors should go follow them on IG, not give them extra money in the form of investments. But what makes this a bad idea? Buying out of love usually results in buying at the wrong time or holding on too long. Investing is a financial decision. If the decision isn't financially based, it's easy to miss red flags that the beloved company is struggling. Mistake number 11, failing to diversify. Mistakes will be made, so it's critical that a new investor not put all of their eggs in one basket. While it's true that younger investors can typically endure greater risk, all the more reason to diversify. There are several asset classes to consider: stocks, bonds, real estate, exchange-traded funds, ETFs, commodities, cash and short-term equivalents, CCE. An investor can also invest both domestically and foreign. They can buy mutual funds that invest in large companies or small ones, and, of course, they can actually invest in physical real estate. However, diversification also has its negatives. It favors a long-term investment strategy versus a short one, so they may not be in the best position if investors need their money now. A diversified portfolio may also have higher fees, so every investor should weigh the pros and cons. Mistake number 12, waiting to break even. Here's what this means. If an investor paid $1,000 for a stock and it sank to $500, they'd wait until it gets back up to what they paid for it to sell it so they could at least break even. This waiting game is a mental fallacy, meaning it goes against logic. If an investor has already decided that they will sell when it gets back up to what they paid for it, they intuitively know they've picked a loser. It happens. If a new investor has identified a loser in their portfolio, most veteran investors have too. That stock is unlikely to ever get back up to what they paid for it. The more likely scenario is that it just keeps losing money. Instead, investors should cut their losses and sell and put that money somewhere it will grow. Mistake number 13, investing too conservatively. The average inflation rate is around 2 to 3%, and in some years, like 1979, it was over 10%. This means that $1 today is not worth $1 next year. It could be 98 cents or even 90 cents. Doesn't sound like a big loss until an investor realizes that they lost that 10 cents on the dollar on $50,000 that was parked in a savings account, earning a 0.01% interest rate. To stay ahead of inflation, an investor typically has to take on some risk. But the good news is that if they avoid the foolish mistakes on this list, they are reducing their risk. Mistake number 14, lack of patience. Slow and steady wins the race in investing. As new investors, people often hear these stories about people winning big in the stock market and becoming a millionaire overnight. But those occurrences have similar odds to winning the lottery for a new investor. That's 1 in 13,983,816, by the way. Chances are most new investors have chosen to invest in the stock market because they understand that buying lotto tickets every week isn't a great investment strategy. New investors who can stay on a course and be patient while learning from their mistakes will perform much better than those who see the stock market as a get-rich-quick engine. If it were that easy to turn 1,000 into 1 million, everyone would do it, and they don't. Mistake number 15, no plan. Fail to plan and plan to fail. New investors may be learning, but they can certainly start hammering out their strategy so they can see what works. A basic plan includes the amount needed to retire, how much to invest each month based on the amount needed to retire, overall investment strategy, which may change over time. Did we miss any foolish mistakes new investors make? Let us know in the comments. Also, if you haven't subscribed to our channel yet, then don't forget to do it now in order to receive more of our amazing and informative videos.